Let's talk about specific stocks. Let's focus on Piramal Pharma, which is in focus. The stock is up over 5% in trade today. The company said that it estimates to be a global pharma health and wellness company by 2030. To discuss the roadmap for this and a lot more on their CDMO business, consumer business and more, I did catch up with Nandini Piramal, who's the chairperson of Piramal Pharma. Listen in.
One of the things we wanted to do was say, what do we want to be by 2030? And as you rightly said, we want to be a $2 billion company. But one of the other things we also want to do is increase our EBITDA to 25%, which means a tripling of EBITDA. And in the meantime, we also want to reduce our debt to EBITDA ratio or to 1, less than 1. So the way we plan to do that is our three businesses, we believe that there are secular and macro tailwinds that will help us. In the contract manufacturing business, we want to focus on innovative work. Last year, our innovation work was about 50%. We want to focus on integrated projects which cross more than one site, whether it's east and west or even two sites. And we want to focus on cross-selling and deepening our capabilities. Third, our differentiated offerings, whether it's antibody drug conjugates, high-potent API, sterile fill finish, also give us very good options to work with customers. And that's the things that attract customers to us. They're kind of magnets and help us get that more RFPs.
You're expecting a tripling of EBITDA. You're estimating margins of 25% by 2030. Till now, the margins have been extremely volatile for the company. How do you expect to achieve 25%, and is that a sustainable rate?
We do think 25% is sustainable, and the way we want to do it is primarily by doing operating leverage. As we increase utilization at our sites in the CDMO business, we expect that operating leverage will flow through to EBITDA. As we actually do higher quality revenue, whether it's the innovation or the differentiated offerings, those margins are higher, and we expect to see that benefit as well. We're also continuing our focus on operational excellence and cost and procurement, and we'll continue to manage that.
What is your near-term guidance for the margins? Because in Q1, there was an improvement year-on-year, but overall, the trend has still been volatile.
I think overall, we're still saying for the year, we want to keep early teens, actually mid-teens growth and improvement in EBITDA and a significant improvement in PAT this year. So I think we're going to stick with that at the moment.
Okay, so that means that you all will be in the black on the bottom line?
Yes.
Okay. What is your guidance in terms of profitability by 2030? Because the other concern has been the volatility in terms of your profitability or your losses which the company has been making. Can you give us a sense in terms of what the profit target would be?
The profit target will, see, as EBITDA improves, we will see an exponential improvement in PAT. I can't actually give you a specific number, but we will, because EBITDA will improve and debt to EBITDA ratios will be lower, we do think there will be a significant improvement in PAT. But one of the things is that the year is cyclical. So sometimes in the first quarter, it is a little bit lower, but then the way the fixed costs work, there might be a loss, which there was the first quarter, but we expect to be in profit for the year.
The company's targeted $1.2 billion from CDMO segment. What is the expected driver? Can you tell us how much is probably going to be innovation-led CDMO, which is around 50% of your business? How much do you expect that to grow to? And how much will probably be from emerging biotech, which has faced funding problems in the US?
So currently, our innovation-related work and our differentiated work has been growing faster than the others. And we expect to continue that going forward. We also and it's hard for me to give you a number between emerging biotech and big pharma, because what is happening is innovation is happening in emerging biotechs, but they often get bought by big pharma. So what we're seeing is right now a third of our business is between generic pharma, then a third by emerging biopharma and a third by big pharma. But what has happened is we've often started our business in emerging biopharma. They get bought by the big pharma, and sometimes the big pharma don't change it. So that's the benefit is, so I can say I can start out in emerging pharma and then it becomes big pharma. So it's very hard for me to give you a number.
Okay. All right. But overall, the trend has been higher order intakes for the CDMO business, considering that in Q1, your revenue was up 18%.
It has been higher, and where the leading indicators of requests for proposals have been very good. Obviously, biotech funding is still a challenge. Over the year, it has been better than the last 2 years, but it's not reached the peak yet.
Okay. $600 million from complex hospital generics, which is basically your anesthetic products, etc. You've been facing pricing pressure in some of your key products in the US. Where does that stand currently? And do you expect all of these factors to probably settle? How much of complex hospital generics will be from the US? How much of it will be from other geographies by 2030?
So the biggest market is the US, and so obviously we will continue to focus on it and grow products. We will add new products to that and expect to see revenues from the US still continuing. In particular, in inhalation anesthetics, we have about 40% market share there. We don't expect that market share to grow too much, but we will continue to focus on growth outside the US for inhalation anesthetics in particular, because we don't have as much market share in those places. But in the other complex hospital generics and the new products that we intend to add, those will be focused on the US and Europe.
And pricing pressure?
This is a generics market. There will always be pricing pressure, but the pressure is, I would say, slightly less than other generics because there are just fewer competitors.
All right. Consumer health, that's been growing in double digits. Your power brands such as Little's, Lactocalamine grew around 19% in Q1. You're estimating $200 million in terms of sales. How much do you expect the growth rate to probably accelerate within this segment? What do you expect it to be driven by? And any kind of monetization plans for this particular segment, which is, playing into the consumption story of India?
I'm very excited about the consumption story of India. I think there is a great good value for money consumer products, and especially as the Indian urban class is growing, they're focused more on health and wellness. So that's something I'm very excited about. I think our power brands, that's the things that we will focus on, whether it's in promotions or whether it's in new products. Over the last few years, we've seen the growth, and we expect that will continue growth. Our tail brands will continue to grow at market rate, and as they grow bigger and at the right time, we'll decide if we want to actually invest in media and promotion then.
Your net debt to EBITDA has improved. It was around 5 times at the end of Q1 FY24. It's 2.8 times as of Q1 FY25. And now you're targeting even a lower net debt to EBITDA, around 1 times by 2030. Give us a sense in terms of the trajectory. Where does it stand today? And what can we expect subsequently in terms of reduction?
So right now it is 500 million approximately, and net debt to EBITDA. We intend to reduce it as a ratio because we will be growing EBITDA, and we will use some of our free cash flows to both do CapEx as well as reduction in debt.
Okay, so when do you expect to get to 1 times? Would it be probably
by 2030 for sure, but it will be the ratios will be reducing across.
What does that mean for M&A? You've done around 15 M&As till now, which have been successful. What would your M&A strategy be, considering that you will also want to reduce debt?
We'll continue looking at M&A. I think if we see the right opportunities at the right price and basis on debt and cash flows, we will look at them.
Okay. Quickly, before we wrap up, Nandini, wanted your thoughts on the Biosecure Act. And it's been passed by the lower house in the US government. What is your sense in terms of an opportunity from the Biosecure Act for Piramal Pharma?
I think the Biosecure Act hasn't been passed yet by the Senate, and it does have an 8-year time period. But what it has forced everybody to take a look at and see what is their strategy for their supply chain. And one of the benefits that we have at Piramal Pharma is that we can offer an East and West solution that doesn't include China. And I do think that is an opportunity.
Okay, but are you seeing only more queries at this point in time, or are you participating in pilot projects?
So in the CDMO business, it is a long sales cycles, and so people are sending out a lot of RFPs, but I don't think anyone has decided yet.
Okay, so that is the management of Piramal Pharma talking about the Investor Day highlights which took place. The stock is up around 5% They have tall targets of around $2 billion in terms of revenue, as well as an EBITDA margin improvement all the way to around 25%. To put it into perspective, they did around 10 to 11% margins in Q1 of FY25. So they are expecting sustainable improvement and a reduction in debt going forward as well. So that's the word coming in. We'll take a short break.